Hello, welcome to another episode of Supply Chain Spotlight. I'm George Abernathy, the proud president of FreightWaves, and I'm really thrilled to be joined by someone I've known. We were just talking about it. It's remarkable to think that we've known each other for a little bit more than a decade. Joost Thesseling from CI Capital Partners. Joost, thanks for doing this today.
No, thanks for having me. Appreciate it.
We're really looking forward to the conversation. Let me level set for everybody a little bit about CI and a little bit about Joost. CI Capital Partners, throughout 27 years of investing in private equity, CI Capital Partners have helped to make many extraordinary entrepreneurs transform small and medium-sized companies into market leaders through investments in organic growth and add-on acquisitions. And we're going to talk a lot about that today. CI are long-term investors who've acquired more than 350 companies worth approximately $10 billion in enterprise value since 1993. My friend Joost is a managing director and joined CI Capital Partners back in 2000. Joost is chairman at Hero Digital, Maroon Group, Save-A-Tree, and Redwood Logistics. We'll talk about Redwood. He is also a director at Epiphany Dermatology, Impact Group, PRA, Summit Companies, and WTS International. He's obviously taking a lot of phone calls these days from his place in New York. So previously, Joost held positions at Engelhard Corp and PricewaterhouseCoopers in both Europe and the US. He received his master's in business economics from Erasmus University School in Economics in Rotterdam, the Netherlands. And if we run out of time and have a little bit of extra time at the end, Joost and I are going to do a little bit of soccer talk for all of you World Cup fans. So stick with us all the way to the end. So Joost, let's get to it a little bit. We've got a lot to talk about. You have a broad portfolio of companies. That's why I wanted to level set that way. As you see the market through your portfolio operating companies, what are you seeing in the equity market with regards to deal flow in 2020 right now?
Yeah, I mean, I would say that pre-COVID, the deal market was as hot as I've seen it in the 20 years I've been doing this, right? I mean, valuations were up there, deals were getting done faster and faster. The logistics sector, and I'm talking about the general M&A market, the logistics sector, of course, has been a little quieter, not a lot of data points on logistics companies in the mid-market in 2019 and into 2020. And a lot of that, of course, has to do with the fact that the freight market was in a downturn since sometime, towards the end of the first half of 2019. That's been reflected in companies' performance, and that has basically led a lot of companies who didn't have to sell to say, let's wait until there's better times until we put ourselves up for sale. But the general market was extremely active prior to COVID. Of course, when COVID happened and sort of everybody started to realize what was happening in mid to late March, April into May, I would say, and we certainly were, I think, pretty much every private equity firm and strategic buyer turned, internally, right? I mean, we were focused on our portfolio. Strategic buyers were focused on their own business, so nobody was really thinking about M&A. And basically, what also started to happen is that the credit market shut down, right? Because banks were looking at their portfolio. There were a lot of distressed credits or credits they thought were going to get distressed, and naturally, banks were very reluctant to put more money out, and that had a further dampening impact on the M&A markets. What we've seen once the dust started to settle a little bit and the lockdowns were over, right? So into June, July, I'm talking now. You started to see people picking their head up, and we ourselves, you just mentioned it. We are very active. All of our companies are very active acquirers, right? I mean, part and parcel of our strategy is to buy a good platform that operates. It could be in logistics, could be in a different industry, that operates in a large and fragmented industry, and then use add-on acquisitions to consolidate and build that business and create value. We had put that program on hold for all of our companies, but in June, late May, early June, we started to pick our head back up and started to look at add-on acquisitions, and in fact saw some pretty interesting opportunities to take advantage of the distress that we saw in the market to get some good buys, right, on the acquisition side. So we probably have closed since early June 9 or 10 add-on acquisitions across the portfolio, and we have several more under LOI and in the pipeline. We expect to do several more this year.
So as you talk about that deal flow, Are we back to a normal level of deal flow? Are when will that occur? And what would it take? What would it take for you to see it be back to where it was pre-COVID? And I don't want to get too political here, but will the November election have some level of influence around that based on some of the impacts to capital gains and the like that could happen?
I would say that the level of activity is not back yet at where things were. But what's interesting is there is an incredible amount of money on the sidelines, right? I mean, there's private equity firms who now have not put any money to work in most cases for the better part of 6 months or longer. And they've got limited timelines on their funds. Strategic buyers are flush with cash in many industries, right? So people are eager to do deals. But the issue is, of course, that many acquisition targets are not looking so good because the impact COVID has had, right? So what you're seeing is that companies who have fared well during COVID, who navigated through the storm pretty well, or maybe perhaps did even better than they thought they would because of COVID, right? There's certain industries and sectors that are doing better than people expected. Those companies, when they put themselves up for sale, we've seen some incredibly high valuations, arguably higher valuations than what we saw pre-COVID for those businesses. But that's a relatively rare breed of company. It's got to be a certain size, high quality, and again, they sailed through COVID and made it through pretty well. The dynamic you saw in the third quarter is lots of money out there, right? And for the right company, people are willing to do some actually pretty crazy things in some instances, right? When I talk to bankers in the market, what's happening now is that phenomenon, right, where these companies sold at very big prices. What's happening now is that there's now a lot of other sellers who are saying, okay, maybe I should go sell my company, right? So people see in general a pretty good supply of businesses coming into the market in Q4. And some bankers are actually concerned that there's going to be so many businesses coming to market, right, that even though buyers are eager to buy them, during COVID, it's a little harder to do due diligence, right? It's hard to get in front of people. Everything is a little slower, takes a little longer, it's a little less efficient. So there is some concerns in the banking community that all this additional supply of businesses is not going to, there's not enough bandwidth among buyers to really go after those.
So many of the deals are made that you're, so closely involved with during the due diligence revolves around what kind of fit you see when one of your portfolio companies is making that acquisition. It's got to be a whole lot tougher now to figure out that fit when it's COVID and you can't spend as much time getting to know and understanding the culture of those companies that you're looking at acquiring. That's obviously stretching out the deal times. Is that correct?
Yes, I think that's stretching out the deal time, or you're fundamentally going to have to get comfortable with doing less due diligence and being happy with a lesser amount of comfort. And some buyers, I think, are getting to that point, right? I mean, I think I've heard of some companies, during the early stages of COVID, a lot of people were saying, well, I'm going to do meetings over Zoom and have phone calls and everything else. I'm going to do all my work, but before I close, I'm going to have to meet management, right? And I think in many cases that is still, and it's becoming a little bit easier to do that again. But I think I have seen some deals getting done where people were fundamentally, did not meet management before they closed the deal, right? But our view is that everybody's gotten a little bit better at Zoom, right? And you can do a lot over Zoom, and I think you can be creative with the format of how you're setting up calls. Instead of having 8 people on one side and 8 people on the other side, you can do more one-on-ones, and so we're sort of modifying our due diligence processes to do as much over Zoom as we can, and then find a way to smartly get together. And I think today things are at a point, and restrictions are down to a point where that's possible.
I'm going to shift a little bit and focus in on, and full disclosure, Joost and I have known each other because we worked together. My time at Transplace, I was our principal investor for almost 4 years there, and had a terrific, successful time where I think we acquired 3 or 4 businesses during that time. And as you look in the logistics transportation market, you're the chair at Redwood. There's been so much volatility, you talked about it, here during COVID that has so severely impacted some of the KPIs, some of the metrics, some of the normal things that you would look at inside of transportation logistics companies. You know, have you had to take some leaps of faith or looked at different ways to value those asset or non-asset transportation companies?
Yeah, I would say that, and Redwood, at Redwood, we're looking at a number of acquisition opportunities, and I think we'll do a couple of deals during the remainder of this year. With Redwood and with our other companies, basically the way we're thinking about it is that if you've got a business that either has a good percentage of its revenue under contract, right? So you know who your customers are, you've got a long-term relationship with your customer, right? Even if your revenue, even if the business's revenue was down in April and May and into June, right? There is now sufficient time between the expiration of the lockdown restrictions, right, which really caused most of the economic distress when you look back at it. And now there's enough time has expired where you can see how those businesses have recovered, right? And generally, we are staying away from companies that went down and haven't come back up, right? But again, if you've got a business that's got long-term customer relationships, even though those relationships generated less revenue during the lockdown period, if you've seen a recovery to levels close to or at pre-COVID, even though you don't have a full year of that, we're willing to give those businesses credit for that, for adjusting out the COVID impact, if you will.
How do you look at leadership? Just think about all of the activity, and obviously COVID slowed it down, but there's been a lot of activity inside of logistics and transportation, a lot of companies that have brought in and done acquisitions, some more successfully than others. And I give CI a lot of credit, and the time we worked together, we were very successful at merging those together. How do you understand and know that the management team, what are the characteristics of that management team that you look for that can make those integrations happen that will end up yielding that shareholder value you need to deliver X number of years down the road?
Yeah, I mean, we look at basically whether we look at an add-on for Redwood or for one of our other companies, or we look at a new platform. They're generally companies that are, smaller than they can be, right? Otherwise, we wouldn't be interested. And I always look at the capabilities of the team running those companies relative to the tools they have, right? So if you've got a small company that doesn't have access to capital, that didn't have the resources to put in technology, right? But despite that, they've gotten the business to a good level, and they've done a good job, right? We then look at, okay, so what can we bring to the table, either at CI or in the case of Redwood doing add-ons, what can the Redwood team bring to those companies with our technology and processes and customer relationships, et cetera, and what can we do with that business, right? And that's really, that's one of the key things we look at. And then, of course, when you're looking at doing an add-on acquisitions, and you remember this from Transplace, right? There are many good companies in the logistics space that on paper are a great fit, but when you look at the people running them, doesn't mean that they're bad people, but if the personalities and the chemistry is just not there, right, and the culture, there's just not a cultural match between, the portfolio company that's making the acquisition and the add-on. We have basically shied away from making deals for that specific reason, because particularly in logistics, where while technology is important, there's assets and there's a lot of aspects to these companies. The people side of the business is incredibly important, right? So that is a very, very important criteria for us, both for add-ons but also for new platforms, right? I mean, we really spend. I always say to entrepreneurs we talk to for a new platform, I always say, between now and closing, right, we got to do three things, right? We've got to do due diligence on your business, look at contracts and your numbers and everything else. That's in some ways the least important part, right? The two important parts are, we want to get behind your vision, right? We want to understand your vision and get behind it. We don't want to come in and say, you got this all wrong, here's our vision, we're going to do that instead. We want, just like we did at Transplace, well, we're going to get behind your vision. So we want to talk about that and make sure that we see completely eye to eye on that, right? And then the third thing, which is important, is let's agree on the resources we need to execute on the vision, right? Because even if you want to go to the same place, if one party wants to spend a lot of money to get there and the other doesn't, right? You could still have a lot of disagreement along the way, and it all comes back to people having the right chemistry, and being on the same page in terms of where you want to go.
Let me leapfrog on that a little bit. During COVID, have you found that the operating partner, have you found that you've had different things you've had to address? You know, I always look forward to the times that we had the opportunity to interact, but with COVID, are there other challenges that have come that a CI or you in your role on a board can help that company deal with?
Yeah, I would say, I'll say two things. On the operating part, we don't have at CI the traditional operating partner model. A lot of firms, as you know, they have 2 or 3 or 4 people on board who obviously, have run great businesses and great track record. That's why they're there. And they're almost being put on boards as a generalist, sort of smart business person, right? And that has a value, but what we think is more valuable is to, depending on the business we look at, right, we want to find 2 or 3 people who have extremely specific experience that is relevant to that business, right? It could be the CEO who ran the company 15 years ago, right, and is now retired and knows a lot about the industry and a specific business, or somebody we just want to make sure that people have very specific expertise. So we have networks in all the verticals that we do deals in and that we're active in, and we generally pick from those networks when we get close to a situation, and those people help us do due diligence. They put their own money in the deal, and then they sit on the board to help us build value, right? So just to react to the operating partner part of your question, in terms of what we've done under COVID, so we basically mid-March we stopped everything else, right? And we went to every single portfolio company, and we included the outside board members in this, and management, of course, and we said, okay, we've got to build detailed COVID operating plans, right? What do we think is going to happen in April, May, when it was clear then that the economy was heading towards lockdown, right? So what does that mean for our business, right? And how do we think we're going to come out of that? And given that, what do we need to do with our cost structure, right? Because we obviously want to make sure that we stay within, covenant compliance. We've got enough liquidity. We want, obviously, we want to make it through the storm, right? And what has turned out to be one of the trickiest thing to get right, and I think we got it mostly right across the board, is to basically, so we had cost-cutting plans ready for every business, right? And in some cases, we implemented cost cuts, right, because it was necessary to do so. But in other places, but how much to cut, or whether to cut, and in some companies we didn't. We wanted to be very conscious of the fact that what we didn't want to do is basically cut costs, and then when the market recovered, and it was unclear back in March, April, if that was going to be in June or in October or in 2021, right? But we want to make sure that we have gained share and we come out stronger and we can grow the business, right? And we're not sitting there flat because we've now cut all the muscle out of the company, right? So we have been, in general, very careful not to cut too many costs because we wanted to come out, growing, right? And you look at Redwood, for example. As you know, in the brokerage business, which is a increasingly technology-driven business, but there's still a lot of people working in brokerage, right? And some of the brokerages out there have basically said, look, we got less volume, less revenue opportunities, so we need to cut costs. We haven't done that, right? Because we felt that if the market recovered, we wanted to make sure we had the horsepower and the manpower to grow out of it. And with the market picking up in the last, 3, 4, 5 weeks, as I'm sure you guys have seen, it looks like we've made the right decision there.
We could go into a wonderful debate about whether this was a black swan or a white swan event, but I'll leave that for smarter people. It was a monumentally impactful in what you did in March and April with your portfolio companies and management is so impressive. What will the lesson be? Will there be more consideration from your perspective, sitting on so many boards, of the what if scenarios that could happen? And obviously, we weren't capable of predicting COVID, though again, there's your black swan, white swan. Will this have a long-term impact on how you and how CI look at and expect your companies to be prepared for the unexpected?
First of all, I think it's going to change the private equity business, and I think for the better, right? Because my life was very much, as you know, because we've talked about it in the past, right? Is getting on an airplane, to Houston or whatever, and you're spending 2 days to get to a 2-hour meeting, and the reality of our business is that 95% of the time that meeting, when you're 10 minutes into it, you know that you didn't have to take the trip, right? So the fact that we can do more over video, and of course we don't, as you said, we don't want to lose the personal connection with the management teams, and we need to build those relationships. But I think, you can do 1 or 2 or 3 Zoom calls and then take the trip. And I think that means that we can actually do a lot with that time that we otherwise would have wasted at LaGuardia Airport, right? So I think that's part of it. I think the other thing is, and this goes back to the company, is that as part of, we built these operating plans, right? What we also did with the business, I mean, we normally got basically, monthly results at the end of the month, and then we would have a call with the management team to talk about them, and that's basically what most private equity firms do and did. But what we did during COVID is we said, let's make sure that our companies, to the extent they don't already have it, have daily dashboards of the key metrics they ought to be tracking in their business. Not monthly looking back, but real time every day, right? And once those metrics, so we helped our companies create those dashboards, right, of daily metrics, and once those were in place, it was easy for us to get access to those. So we now have daily and weekly tracking, real-time tracking of where the company's performance is going, and it's incredibly useful. It's obviously especially useful in times of turbulence, which we've seen over the last 6 months. But I think that's very much a sort of an operating philosophy that we'd like to keep. Right, is just to be, and it doesn't mean that we have to be on the phone with the management team every day to ask, well, why did this KPI go up or down? But to have sort of a real time view on what's happening in the business is extremely important. I don't want to lose that.
I think in the same way as you described, Zoom or Google Hangouts or Microsoft Teams gives us the ability to do things that we would not have been able to do 15, 20 years ago, and we can now. And I think similarly, that data that you're able to have the portfolio companies collect and then show and then display for themselves to utilize and you to watch, that's a lot of what FreightWaves has had success on, is finding all that data that now is available and people can utilize and see signals. And that signal is really what's important. So just turn a little bit in our last couple of minutes here. You talk about LaGuardia won't see you as much as it used to. How dramatic do you think that change is going to be? When I was working with you and at a DFW 140 to 150 flights a year, look into the crystal ball. Joost Thesseling and the deal volume is going to be what it was. Let's assume that. Will you fly half as much? Where do you see that ending up?
Yeah, it may be half as much. I think, in reality, a lot of it is going to depend on the market, right? Because we all know that if there's a good company for sale and the banker who's selling the company is saying, well, we're going to have 10 meetings to bring 10 private equity firms down to Tampa, Florida, and you need to be on a plane or otherwise you can't participate, then we're obviously going to do that. But I do think that bankers and sellers, right, sellers as well, but also private equity firms and strategic buyers, I think there generally is, just like in the rest of the business world, I think there's definitely the desire to spend less time on airplanes, and keep some of that time we all gain back, right? So I'm certainly looking forward to doing that, because it's you don't realize. I mean, everybody thinks, you can work while you wait for your flight in the airport. You can work on the plane, and sure, you do a little bit of that, but it's not the same thing as sitting behind your desk and doing real work, right? So it's nice to be, this efficient, and I'm hoping that we can keep this up, at least most of it.
I really appreciate the time. Sadly, this just ripped by, and I want to thank you. I hope our paths cross in actuality, physically, at some point in the not too distant future. But this was a wonderful chance to have the opportunity to pick a brain of somebody I'm really proud to have had the opportunity to work for. Joost Thesseling, managing Director at CI Capital Partners. Thanks for doing this. I really appreciate your time. Thank you, Joost.
Very happy to be here. Thank you. It was great seeing you, George.
Take good care. Thanks, everybody. Appreciate your time. Be well.